Hi, this is Anita from Real Estate Crunch. I assume that many of you that are listening because you want to understand more about real estate, you're looking to purchase real estate, or maybe you're just interested in the subject. Today, I want to talk a little bit about how the real estate market works. In specifics, some of the economics of it, the supply, the demand, and the trends. And you might ask, well, why do I need to know this? Well, this is actually really important to understand because in understanding this can help you if you're buying for yourself make the best decisions possible. If you happen to be a real estate agent, this is really important for you to understand because your customers will depend upon you to be able to understand these kinds of things for you to help them make the best decision possible. So let's talk first about supply. Supply in real estate it really refers to the availability of property for sale or rent. There's several factors which could basically influence the supply side of things. One would be new constructions. The number of newly built homes or commercial properties can directly impact the supply. When construction activity is high, supply increases. Often, then this will help stabilize the prices. Sometimes when the supply contracts can increase the price if construction slows down due to economic downturns. So these can be, there can be things or regulatory problems or labor shortages. Could all be things that can actually slow down some of the new construction. And that can actually have an effect on the real estate market. Zoning laws and regulations can also have an effect. That, government regulations such as zoning laws or land use policies can limit or expand the availability of real estate for development. Strict zoning laws can restrict new construction, reduce supply, and increase property value. And this goes too with ability of land. That, densely populated urban areas where land is more scarce, they can restrict the supply of the number of new developments, leading to limited supply and higher property prices. In contrast, suburban or real estate areas could have more available land, leading to more elastic type of supply. Interest rates and financial conditions can have a difference. If the interest rates are really high, or the country's in a depression or a recession, people maybe are not looking to buy. They're going to stick with what they have. This could actually affect real estate prices. It could be that there could be fewer buyers out on the market looking to really buy property that normally would be. That actually goes with understanding of the demand. That, demand is something like how high is the demand in the area? Economic growth and employment can be one thing. Let's say that you're living in an area and suddenly a large employer is going to move in and suddenly they're going to hire 40,000 people. Well, there could end up being this shortage of housing there, which could drive all the houses and the property values up. So a strong economy with job growth increases consumer confidence and disposable income, leading to higher demand for housing and commercial properties. Controversially, like economic downturns can reduce the demand for potential buyers and investors. They can be hesitant to make that big decision to be able to buy something. Demographics and population growth can also make a difference. Areas which are growing, usually a lot of times have higher prices. They can significantly impact real estate. Millennials entering the housing market or first-time buyers can drive demands for starter homes, while aging baby boomers, influence can demand for retirement communities. Things as interest rates and mortgage availability too can also, make a difference. Of the, interest rates are low, the mortgage borrowing becomes more affordable, encouraging more buyers to enter the market and increasing demand. So, the interest rates are lower, more people are saying like, hey, this is a good time to buy, let's start buying now. Investor activity, real estate investor activity can also play a role, for it, as can consumer preferences and lifestyles. This is, you look at some places that are warm like Florida, maybe by the ocean, people want to live there. Especially people that are retiring want to, have traditionally wanted to go there. This can make a demand and make the prices go higher. For example, during the COVID-19 pandemic, increased the demand for suburban and rural homes as remote work became more common. Now that as there tends to be more of a shift away from the remote work, this could actually change too, where, maybe some of the urban areas start seeing an increase. Market cycles and real estate trends can also make a difference. There's 4 phases of the real estate cycle. First of all, the recovery. After an economic downturn, the market begins to recover as demand slowly begins to return. Prices remain relatively low, and investors often find opportunities for undervalued property. So this could really be a good time to buy when you're in the recovery mode. Expansion, this is when growth increases demand, and this can be higher property prices, new construction. This could be, there could be rising home sales, increased rental demands, and substantial investment activity. Hypersupply is what happens when the supply begins to outpace demand. So suddenly now everybody's been expanding, everybody's starting to build new homes, everyone's starting to do this, and suddenly now there's a lot more supply out there than there is a demand. And this leads to a phase of excess inventory. And this can lead to price stabilization or declines if the economic growth also slows at the same time. And then the last one is like a recession. This is where the market, contracts as demand drops, often due to interest rates or economic downturn. Property values then begin to decline, and fewer transactions occur, making the bottom of the cycle, marking the bottom of the cycle before recovery begins. So in other words, in a recession, you need to be careful, because if the market could bottom out. In other words, if you buy in the middle of the market, you may be bought too high. You need to really, if you're looking to buy and to get a deal, you need to buy when it's actually bottomed out and recovery is taking place. There's several ways that, you're saying, well, how can I know these trends before they actually happen? All of this sounds a bit complicated. Well, here's some ways that you can. For the area that you're looking to buy, you can look at economic and employment trends. If there's strong employment, the economic trends are looking favorable, you can look at all of that to see how the demand could shift. Population migration patterns. Are people moving into the area? Are people leaving the area? Are the interest rates changing? Are they going up or going down? What kind of policies is the government putting in place? Are there some government policies or some tax incentives happening? And what about technological innovation? The rise of smart homes or that type of thing, or AI-driven property management can influence also market trends. So you need to sort of understand all of these dynamics together, and then you can be able to look and see some of the trends. If you're interested to be able to find out more, we've written a blog post on this, and we will put the link to the blog post in the description below, how the real estate market works, supply, demand, and trends. We'd like to thank you so much for listening. We hope that you'll become part of our community. Press that subscribe button. Press it now. We'd love to have you join with us. Thank you.